The Behavioral Investor by Dr. Daniel Crosby. Key takeaways. Number 1. Markets are primarily psychological, not mathematical. There is no understanding markets without understanding people. Human nature drives markets. Financial markets are fundamentally social constructs driven by human psychology rather than pure mathematical calculations. Our ability to create shared narratives and collective beliefs is what enables complex financial systems to function. Collective storytelling matters. Humans uniquely create and believe in collective fictions that shape economic behavior. From money to stock markets, these shared beliefs create predictable structures that allow economic systems to operate. Markets are essentially sophisticated social agreements about value and exchange. Key psychological mechanisms: ability to cooperate flexibly, creating and believing in shared narratives, valuing collective trust over individual rationality, generating complex social structures through mutual belief systems. Number 2, the human brain is poorly designed for investing. Your brain, 150,000 years old, is much older than the markets, 400 years old, it seeks to navigate. Evolutionary mismatch. The human brain evolved for survival in prehistoric environments, not for navigating complex modern financial systems. Our neural hardware is fundamentally misaligned with the cognitive demands of investing, leading to systematically poor decision-making. Brain's investment limitations: processes information slowly, prioritizes immediate survival over long-term planning, consumes massive energy while making inefficient decisions, predisposed to quick, emotional reactions, struggles with probabilistic thinking. Neurological challenges: limited working memory, strong loss aversion, difficulty processing complex long-term scenarios, tendency to rely on cognitive shortcuts. Number 3. Our evolutionary traits work against smart financial decisions. You are not built to be happy or to make good investment choices. You are built to survive and reproduce. Survival mechanisms undermine investing. The same evolutionary traits that helped our ancestors survive in dangerous environments now sabotage our financial decision-making. Traits like immediate risk assessment and tribal thinking are counterproductive in modern investment contexts. Evolutionary investment pitfalls: loss aversion from prehistoric survival needs, preferring familiar over unknown, quick emotional responses, prioritizing short-term safety over long-term growth, tendency to follow crowd behavior. Adaptive strategies: recognize innate behavioral biases, develop systematic investment approaches, create rules that counteract instinctive responses. Practice emotional detachment. Number 4. Ego distorts investment judgment. Believe in yourself is really bad advice for investors. Overconfidence destroys returns. Most investors dramatically overestimate their abilities, leading to poor decision-making. This ego-driven approach causes excessive trading, under-diversification, and failure to learn from mistakes. Ego's investment impact: confirmation bias, inability to admit being wrong, overestimating personal investment skills, ignoring contradictory evidence, creating false narratives about market performance. Humility strategies: embrace uncertainty, seek diverse perspectives, track and analyze investment decisions objectively, develop rules-based investment systems. Number 5. Conservatism prevents optimal investment choices. Thinking is metabolically taxing. We have to parse tens of thousands of decisions per day. Status quo bias limits growth. Humans naturally prefer familiar approaches, which leads to suboptimal investment decisions. Our cognitive system is designed to conserve energy by defaulting to existing patterns, even when change would be beneficial. Conservative decision mechanisms: avoiding uncomfortable changes, preferring known risks over unknown opportunities, difficulty processing complex information, tendency to stick with default options. Overcoming conservatism: deliberately challenge existing assumptions, create systematic investment rules, diversify across unfamiliar territories, practice making calculated changes. Number 6, attention bias leads to irrational investment decisions. We tend to confuse ease of recall with probability. Narrative trumps probability. Investors are susceptible to compelling stories that may have little relation to actual investment potential. Dramatic, emotional narratives often override statistical analysis and rational decision-making. Attention manipulation mechanisms, preferring vivid stories over data, overemphasizing recent or dramatic events, misinterpreting low-probability, high-impact scenarios, ignoring base rates and statistical likelihood. Rational strategies, develop systematic evaluation processes, focus on long-term probabilistic thinking, minimize exposure to sensationalist financial media, prioritize empirical evidence. Number 7, emotions dramatically impact financial choices. Emotion provides crude but important shortcuts that preserve mental capacity. Emotional states determine decisions. Our emotional condition significantly influences financial choices, often leading to irrational behavior. While emotions can provide quick decision-making shortcuts, they can also severely distort investment reasoning. Emotional investment impacts: fear-driven panic selling, greed-induced speculative buying, truncated decision-making timelines, overreaction to market fluctuations, difficulty maintaining long-term perspectives. Emotional management techniques: practice mindfulness, create rules-based investment systems, develop emotional awareness, limit reactive decision-making windows. Number 8, passive and active investing. Both have significant limitations. In capital markets, the right thing to do ceases to be the right thing to do when everyone does it. No perfect investment approach. Both passive and active investment strategies have inherent weaknesses. Passive investing can create market inefficiencies, while active management often fails to consistently outperform benchmarks. Investment approach challenges: passive investing can lead to overvaluation. Active management incurs high fees. Most managers fail to beat market indexes. Increasing market efficiency reduces opportunities. Balanced strategy components: rules-based investment approach, low-cost diversification, systematic risk management, periodic strategic rebalancing. Number 9, successful investing requires a systematic, rules-based approach. Systems trump discretion, process over personality. Successful investing demands disciplined, systematic approaches that minimize human behavioral biases. Individual genius is less important than robust, well-designed investment processes. Systematic investment principles, predefined decision rules, minimal emotional intervention, consistent methodology, empirical evidence-based strategies, regular performance review. Implementation strategies: develop clear investment criteria, use screening methods, create automatic rebalancing mechanisms, maintain emotional detachment. Number 10, true investment skill is rare and mostly based on luck. It is impossible to find any domain in which humans clearly outperformed crude extrapolation algorithms. Most investors are not special. Sustained investment outperformance is extremely rare, with most apparent success attributable to luck rather than genuine skill. The increasing efficiency of markets makes beating benchmarks progressively more difficult. Investment skill realities: less than 2% of managers consistently outperform. Skill levels are rising across the industry. Competition makes exceptional returns increasingly challenging. Long-term success requires systematic approaches. Pragmatic strategies: embrace index-like returns, focus on low-cost investment methods, develop robust, rules-based systems, minimize individual discretionary decisions.